financial management. Main topic in this course will be principle in finance, then firm and the financial market. Also, we will talk about financial statements, taxes and cash flow. Also, we will explain financial analysis. Then we will talk about time value of money. Also, we will talk about introduction to risk and return, history of financial market return. Textbook, financial management, principles and applications. Let us to start in the first chapter, principles of finance. Learning objectives. Main learning objectives in this chapter, we will talk about understand the importance of finance in your life, in business. Then identify the key differences between the major legal forms in the business. Then understand the role of financial manager and explain 4 principles that form the basis of financial management, both in business and personal life. Now, in this chapter, we have 4 sections. Let us to start in the first section, what is finance? Finance is a study how people and business evaluate investments and raise capital to fund them. The finance focus on how we can to evaluate the investments and how we can to make a good decision. Why study finance? Finance is very important, not only for business, only in our life. Many personal decisions require financial knowledge. For that, financial knowledge is not associated only with the business. Example, if we need to buy a car, if we need to buy a house, that requires financial knowledge. Now, in second section in this chapter, type of business organization. There are 3 types of business organizations. The first, sole proprietorships. Second, partnerships. Third, corporation. To understand each form, we will define and talk about main advantages and disadvantages for each form. The first form, sole proprietorship. It's business owned by a single individual. Owned by a single individual. The owner is one. He is responsible on all activities and performance. For that, in this type, there is no separation between the business and the owner. Sole proprietorships are generally financed by personal loans from family, friends, from the banks. This type, the capital generally is very limited and large. Now, what are advantages and disadvantages for this type? In this type, the procedures is not complex, it's very easy. For that, easy to start in your business. Also, easy to make your decision. And the tax at the personal tax rate. That means the owner will pay the tax on his profit, not the company, because there is no separation between the owners and the company. While disadvantage for this type, personally liable for the business debts, because no separation between the owner and the business. For that, the owner is responsible on all liabilities. Now, in the first type, sole proprietorship owned by a single individual, while in the second type, partnership owned by two or more. This is type divided to two sections: a general partnership and limited partnership. A general partnership is an association of two or more persons who come together as owner for purpose of operating business for profit. Also, in this type, there is no separation between the owner and the company. Main advantages and disadvantages for this type: also, there is no complex procedures. For that, easy to start in your business. And the tax at the personal tax rate. Also, partnership owners, we will pay the tax, not the company, because also there are no separation between the owner and the business. And access to fund from multiple sources or partner. Example, family, partnerships, banks. There are multiple sources to finance the company. While disadvantage for this type, partner jointly share unlimited liability. The partnership responsible on all liability. In second section, in partnership, limited partnership. While in general partnership, the owner is unlimited liability, in this type is limited liability. Partners are only liable of the amount invested. One of the drawbacks of this form is that it's difficult to transfer ownership of the general partner. Now, we explained the first type, sole proprietorship, and second type, partnership. In the first type and the second type, there is no separation between the owner and the business. While in this type, based on the idea, there is separation between the owner and the business. This type is legally owned by stockholders, shareholders. Shareholders in this type own the company, and the shareholders elected the board of directors. The board of directors manage the activities in the company and responsible on the performance. In general, this type, the capital is very large. The brands for this company also is very expensive. Now, what are advantages and disadvantages for this type? Now, in the first type and the second type, no separation between the owner and the business. While in this type, there is separation between the owner and the business. For that, the liability of owner limited to invested funds. The shareholders is not responsible on the liability. there is board of directors responsible on all liability, responsible on all activities, and also responsible on the performance to achieve the main goal for the company, that to maximize value of investments, value shareholders' wealth. For that, life of corporation is not tied to the owner, is not connected with the owner. The board of directors is responsible on all activities. The procedures to transfer ownership is easy, not difficult, while in partnership is not easy to transfer the ownership. Also, main advantage in this type, easy to raise the capital. No complex procedures to raise the capital. Any company have choices to raise the capital by new shares or by new loans. Now, what disadvantages for this type? Creditor regulation and double taxation of dividends. Now, in the first type, sole proprietorship, and second type, partnership, the owner will pay the tax. The company will not pay the tax. While in this type, the corporation, example, if there are profit $1 million, they will pay the tax, example, 15% as taxation. Also, shareholders will receive their profit from the company, also will pay the tax. For that, there are double taxation for dividends. Now, we explained the first section, what is the finance, and explained what are types of the business organizations. Now, in third section, the call of the financial manager. The call of the financial manager must be consistent with the mission of the corporation. Main objective for financial manager associated with corporation mission, with the objective of the company. Corporation mission for any company to maximize fair value shareholders' wealth as measured by share prices. For that, main objectives for financial manager to maximize fair value shareholders' wealth by increase share price. Now, while manager have to cater to all stakeholders, such consumer, suppliers, they need to make attention to shareholders, to the owners of the company, because the owner elected yearly board of director, elected the manager. The manager responsible on all activities on the company, also responsible on the performance. For that, if the board of director failed to achieve this goal, to maximize the value of the investments, value shareholders' wealth, maybe shareholders will elect another board of director. We will change the manager. For that, all the managers are seeking to maximize the value of the investment for the company. If the manager fail, will lose their jobs. Now, in fourth section, we will talk about main principles in finance. The principles in finance, not four. There are many principles, but we will focus on 4 principles. The first principle, money has time value. A dollar received today is more valuable than a dollar you will receive in the future. Example, if you have $1,000 now, will not equal $1,000 after 1 year, because you can invest the dollar and receive today in interest. Thus, in the future, you will have more than $1, as you will receive the interest on your investments plus your initial invested dollar. For that, money has a time value. This principle, there is chapter talk about money has a time value. We will explain by details all money has a time value. Second principle, there is risk-return trade-off. Main subject in finance or investments, there is risk and return. We can only take risk when we expect to be compensated for the extra risk with additional return. If there are extra risk, I can to take or I can to expect more return. For that, high the risk, high expected return. While if there is low risk, direct will be low expected return. Because if there are extra risk, will be extra expected return. This figure explains the risk and return, the relation between the risk and return. Now, we will see how the relationship between the expected return and the risk. If we have high risk, if we have high risk, direct there is high expected return. While if there is low risk, direct there is low expected return. Extra risk, extra expected return. Principle 3, cash flow are the source of value. Now, profit is accounting concept designed to measure the performance over interval of time. Example, for 1 year, for 3 months, we need to measure the performance. The profit give us the highlight for the performance. We can to evaluate the performance if there is a profit or no. There is profit or loss. While cash flow is amount of cash that can actually be taken out of the business over this time interval. Now, we need to know the relationship between the cash and the profit. It's possible for a firm to report a profit but have no cash. Example, maybe a company announced on $1 million or $2 million as a profit. But the position of the company is not good. Why? Because maybe there is a problem in the cash, maybe no cash. For that, the cash is very important because reflected liquidity position. For example, if all sales on credit, all sales on credit. The firm may report high profit, but no cash. Maybe this will be a big problem for the company because the company has creditors. That will reflect on liquidity position. Example, in 2008, when financial crisis happened, many banks in 2008 announced on high profits and same times announced bankruptcy. Why? Because it has a problem in the cash. For that, the cash is very important in the company. Incremental cash flow. Financial decision in a firm should consider incremental cash flow. The differences between the cash flow the company will produce with the potential new investments, its thinking, making, and what it would make without the investments. Now, in any company, when have cash flow, we can to invest this cash flow in new investments. We can to expand in our activities, in our investments. While if no cash, we cannot to expand in our investments. We cannot to start in any new project. For that, the cash position effected on our decision in the investments. If there are cash, that will be a chance for expand in our investments and expand in new projects. Principle 4, market price reflect information. Investors respond to new information by buying and selling their investments. The information is very important for any investors, for shareholders. If we need to make any decision, we need information from the company about the position of the company, about the activities, about the performance. If there information, I can to make my decision. If there is no information, I cannot to make my decision. For that, the information available reflect on investment decisions for shareholders or new investors to company. Now, if there are good news or good information, that will affect on share price, stock price. If there are good news, direct will be stock price will be increase, will be high. While if there are bad news, stock price will tend to down. For that, we can say stock prices will tend to decrease when there is bad information released on the firm in the capital market. As summary, in this chapter, we explained 4 sections. We started introduce what is finance, why study finance, and explain type of business organization. There are 3 types: sole proprietorships, partnerships, and corporation. Also explain what are advantages and disadvantages for each type. also explained what the role of manager in the business and what main objective for the company corporate mission, and how the corporate mission or the role of manager objectives are associated with the corporation mission. In the last section also explained 4 principles in the finance. Now we finish the first lecture in this course. Thank you for your attention. See you inshallah in next lecture.